Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, April 30th. Equities extend gains as Trump eases tariffs on automakers. There is hope that the things could only improve from now, but the earnings, the company forecasts, and economic data start telling the real story. The story of smashed outlook due to the tariff uncertainties and the tariff disruption. So I will take you to a world tour today, but before that, please be reminded that opinions shared in this video are my own and this is not financial advice. So market sentiment somehow improved yesterday on news that Trump will ease auto tariffs by lifting some levies on imported auto parts and to avoid aluminum and steel levies to stack up to the rest of the tariffs. Probably as a marketing move, as he gave a speech in Michigan yesterday for his 100th day in office. As a result, carmakers around the world and major US indices posted gains at yesterday's trading session. Part of these gains was also due to hope that the US corporate earnings would be resilient to the tariff uncertainty, and part of it was due to the fact that Scott Bessent eyes July 4th to pass a multi-trillion-dollar tax cut package to help improve the new administration's plunging approval rates, and a part of it was due to the fact that the Fed would step in if things got worse. But the majority of news on the wire was less than ideal, to say the least, so let me cite a few of these news that attracted my attention. So first, GM, for example, lowered yesterday's earnings guidance for this year, citing the tariff uncertainty. The company suspended a $4 billion worth of a share buyback plan and postponed its earnings call as it needed more information on the tariff front to make additional statements. So the tariff relief for carmakers actually helped GM recover most of its early losses, but the stock remained offered into its 50-day moving average yesterday and the top of its November to date bearish trend channel. Then, Kraft Heinz cut its annual sales and profit outlook yesterday due to weakening consumer sentiment and also due to the prospects of higher costs due to higher tariffs. The chipmaker NXP, on the other hand, tanked nearly 7% yesterday after warning that a very uncertain environment would cloud the earnings forecast. Then UPS announced it will cut 20,000 jobs and close dozens of facilities. S&P Global lowered its revenue forecast on expectation that companies will delay their debt sales due to highly uncertain market conditions. Then Apple said that they will produce iPhones in the United States. Good luck with that. Then Adidas said it will reflect the tariff-led price increases in prices of the US products. And Amazon first suggested that they could actually show the additional cost of tariffs in their bill, like the Chinese retailers do. But the company had to walk back that decision, faced with the White House's rage, calling the move political, and well, I understand. Then Hilton lowered earnings forecast. PayPal didn't improve its own forecast despite stronger than expected quarterly results, while Spotify had a muted outlook. And finally, Supermicro Computer posted softer than expected first quarter results after the bell yesterday. Then Snap pointed at lower sales, and Starbucks sales also fell slightly faster than expected by analysts. And the rest of this week will be crucial for big technology earnings. Mind you, Microsoft, Meta, and Qualcomm are due to release their earnings today after the US closing bell. Then Apple and Amazon will be releasing their earnings tomorrow. There are reports ahead of the earnings that Microsoft and Amazon could cut back on their spending plans due to an overestimation of AI demand that may have resulted in oversupply in AI. Therefore, these companies' spending plans will be as important as their quarterly results, and hence of lower AI spending from the four biggest spenders of the world that together are expected to spend more than $300 billion this fiscal year could actually send the market back to the bearish waters, while reiterating pledges to continue spending could convince some investors to buy a dip not, however, knowing how big of a hit the US big technology companies will take from the trade war, as Europe, for example, is directly targeting these technology companies to retaliate against Trump's tariff attacks. But anyway, that's the corporate front. On the data front, the news is not brilliant either. US job openings fell in March, and Atlanta Fed's GDP now forecast was revised further down to minus 2.7%, suggesting that the US economy may have contracted by 2.7% in the first quarter of this year. Now, the first official GDP estimate for the first quarter is due today, and a consensus of analyst estimates on Bloomberg hints at 0.4% growth in the first quarter, so expect some disappointment on that front. But happily, disappointment doesn't necessarily mean a risk sell-off for investors, given that a sharp contraction for the US GDP has already been widely priced in. A weak number could eventually lead to a dip buying on rising dovish Fed expectations. And besides that, the US ADP data and CPI updates from the Eurozone countries will also be in focus at today's trading session. So in the FX, the US dollar is slightly better bid this week on signs that Donald Trump is pulling back his tariffs, but the risks remain obviously tilted to the downside for the US dollar. The euro dollar actually saw strong resistance into the 114.20 level after the latest data release yesterday hinted at a softer sentiment across the Eurozone. Lower than expected GDP growth coupled with a higher than expected CPI number from Spain. And today, French and German CPI numbers will be in focus. So note that the euro needs strong growth and soft inflation to break the back of the 115 offers against the US dollar. European equities, on the other hand, enjoy a rare calm in Trump's attacks these days. The SOX 600 index actually extended gains above the 200-day moving average for the second straight trading session. Yet note that the trade negotiations with the United States are not going toward the right direction, so that's a thing that could limit enthusiasm as the SOX 600 index is preparing to test a critical Fibonacci resistance. There in China, the CSI 300 index remains particularly flat on the back of conflicting PMI numbers between the official figure and the Caixin print, mind you. The former suggesting contraction and the latter hinting at a slight expansion in the manufacturing activity of China. So that the worsening global trade sentiment and a 3.76 million barrel rise in US weekly oil inventories last week sent US crude below the $60 per barrel level this morning. So the outlook for oil and industrial metals remains negative, mind you, on gloomy global growth outlook. Now, staying in Asia, in Australia, the CPI update came in stronger than expected by analysts, giving some support to the Aussie dollar. But the Aussie needs to know that China is doing fine to clear that 200-day moving average resistance to the upside. And coming back closer to home, food prices in the United Kingdom posted their biggest jump since January last year due to tax increases and also a jump in national minimum wage that hit supermarkets particularly hard, with a 6.7% rise in the minimum wage. The latter fueled inflation expectations for the UK and tamed the dovish Bank of England bets. As such, on the inflation spectrum, the euro appears to be in the best place among the three: the US, the euro, and the UK, with potential disinflationary impact from the stronger euro and weaker energy prices for Europe. The UK sits in the middle of the range with uncertain inflation outlook and uncertain growth outlook, as the tax and wage increases could outweigh the disinflationary impact of stronger sterling and softer energy prices, while the United States is sitting at the worst place among the three of these, with a sharp decline in US growth expectations and rising inflation expectations for the US. As such, the euro has the most positive outlook among the three, followed by sterling and the US dollar. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.